Hey, good afternoon, everybody, and thanks, Reed, for introducing me. That was great. And just before we get going, I just want to just quickly go over our normal disclaimer material that the presentation is for educational purposes only. We're not broker-dealers or financial advisors. We're not making any specific trade recommendations. Any trades covered in this are going to be hypothetical at this point, and the risk of loss in trading options can be substantial. So please be aware of all your risks prior to placing any trades. Reed quickly went over some stuff about me. I am a professional trader on an auctions desk, and I trade my own money, and I'm also a trading performance coach and mentor. I deal with a lot of people who trade a lot of different trading systems. The systems that I trade personally are complex option spreads, which we'll go over what those are. But I do also deal with directional traders, day traders, swing traders, and that type of stuff. So lots of good stuff there. All right, so when people talk about, when I tell people what I do, right? I'm a professional trader, and I've developed these trading strategies to train professional traders how to trade on an options desk. And they say, what kind of knowledge do you need to be a professional trader? Do you need to have intricate market knowledge? Do you need a financial background, a master's degree? Do you have to listen to advisory services? And the answer is no. You really don't. Really, anybody can make it as a trader. You don't need to experience the market. You don't need to get a PhD. So, I mean, me, for example, I started out as an auto mechanic. I wasn't in the financial business. My parents were in the automotive business. And, I was working in the automotive business. I was kind of sick of doing what I was doing. I realized that wasn't my passion in life. I decided to stop working on cars and started several businesses on my own. I eventually realized I really, really like helping people. So I went ahead and I got into the self-improvement business, which is when I opened LockeInYourSuccess.com. And it was entered as a part-time business for life and success coaching. So while I was doing that, that was like around 2005. I went to this success seminar, and I attended one of those breakout sessions about getting rich in the stock market. And that was really the first time that I was ever exposed to trading. And, getting rich at the time sounded pretty good to me, so I went ahead and I signed up with the company. And at that point, I had never had any trading experience whatsoever. I had never had a brokerage account. I didn't really even know what a stock was. But I figured, how hard could it be? Because I said, hey, a monkey can do this, so it should be easy for me. I was pretty smart. So from there, I probably went down the path that a lot of you guys have gone down. I took the courses. I traded stocks directionally. I did swing trading. I did futures, forex, day trading, and then eventually I got into options. I used advisory services, and I even did this thing called income trading. And I became very, very well educated, and I became completely rich overnight. Well, no, that's not exactly what happened, right? The reality of what I went through is I did everything that all these people were telling me, and nothing seemed to work. Despite all the education, all the time, all the money, I was still losing money in the market. So to say the least, I was just really, really frustrated. And I could have done what most traders do, which is either they quit or they're just going to say, continue down the path and say, what's next? They're going to consistently be looking for the next hot trade, the next big trading system that's going to give them everything they want. At the time when this was happening to me, I was in this mentoring program that specialized in these complex option spreads, which are, they're also known as market neutral or positive theta trades. Some people call them income trades. And I know a lot of you guys have directional backgrounds, so I'm just going to quickly go over, what they are, just so you kind of understand the concept. But, if we were to buy a stock, and we were to put this on an analyzed graph where the horizontal is the price of the stock and the vertical is your profit and loss, it's pretty easy to see if the price goes up, you make money. If the price goes down, you lose money. So a simplistic way of looking at this is I have a 50-50% chance of money. So, people try this and it often doesn't work out. So they figure, hey, I need more leverage, so they buy options. If you buy a call option, for example, you have a similar situation. You have two lines on, except we have two lines on an analyzed graph now. we have this solid line, which is the options value at expiration, and we have a dotted line, which is the options value as of today. And just like having a stock, price goes up, theoretically you make money, price goes down, you lose money, except this time you have something different. Because when you bought the option, you bought something known as time value, and as time goes by, the time value comes out of the option, and it actually loses money, which means not only do you have to be right with direction now, but you have to be right within a certain period of time. Otherwise, you lose. So looking at this, you actually have less chance to make money. I mean, you have more leverage, but you have less of a chance to make money. So you have less than a 50-50 chance of making money. Now, one of the things that when I was struggling with this, they told me, well, that's because you need to sell options. And when we sell an option, for example, if I sell a put option at the same strike I would have bought the call option, I have a little bit different situation. I have a situation where I still want the market to go up, but if the market sits still, eventually this dotted line comes up to the solid line and I make money. Or the market can even go down and I make money. And I thought, hey, you know, that's pretty cool. Only the risk on this thing is kind of crazy. So that has its advantages and its disadvantages. But I went on. But this type of a system actually has a better than 50-50 shot of actually making money, because now the stock doesn't even have to go your way. As long as it doesn't go seriously against you, you're usually okay. So if we're moving forward and we go into complex option spread, this is where we're typically going to sell an option at one strike, buy an option at another strike to cover your risk, and still have that time decay thing working for you where as time goes by it makes money. So this here would be like a bullish vertical spread, right? We make money if the market is still or goes up. Then we have what we call a bear vertical spread, which is makes money if the stock goes down or if the stock goes up only a little bit or it stays still. And from there you can put them together. In other words, this side is a bull vertical, this side is a bear vertical into something that's called a butterfly, where if you make money essentially if you're between your strikes at expiration, you make whatever's on the line here. And then from there, if you spread those apart a little bit, we have what's called a condor, which is a little bit higher probability of doing things. And then, of course, we have what they call time spreads, where you buy an option in 1 month and sell it in another month. And you can create things such as this, which would be known as a calendar, which is the time spread equivalent of a butterfly. And then you have a diagonal, which is a time spread equivalent of a, in this case, a bullish vertical. And then you have your double diagonals, which are, in this case, a time spread version of a condor. So anyway, complex option spreads, they were the latest thing I was losing money at when I finally decided to make a change. I decided to stop jumping around at the next best trading system and the next kind of trading that I could do better. And I stopped looking for advisory services. I stopped looking for trading systems that always win. And I got off the treadmill to nowhere, as I call it, with my clients. So I decided to take a step back and use my success skills, my common sense and business experience to choose another path other than the regular trading path, because I knew that really didn't work. It was becoming evident. So I looked back and I evaluated which type of trading suited me best. And for me, it was the complex option spread. So I decided to stick with that, even though I was losing money at the time. I said, I'm going to stick with this. I'm going to make this work. And then I asked myself two questions. I said, which of these complex strategies that I have, which is capable of making the most money, and which one has the highest probability of success? Because I wanted to work with those two. I wanted to take a path down the highest probability of success, and I wanted to take a path down what made the most money. So I went ahead and I found that butterflies, the butterfly example that we showed you, which is actually up here, actually had the highest probability not the highest probability, it had the highest potential to make money. In other words, it could make more money than any of the other spreads I was looking at. And then I was looking at the bull vertical spread for the most high probability spread, or the one most likely to make money. Turned out to be this trade here. So I went ahead and I just started trading them. I traded hundreds of them. You know, I did very, very small trades, and I didn't care if I made money or lost, because that's the way you learn. You don't care if you make money or lose. You just do these hundreds of trades after trades after trades. I just wanted to learn as much as I could, as quickly as possible, and gain the experience. Because ultimately, in any field, you need to gain experience in order to do well. So eventually, after doing this, I decided to stick with one index, which is called the Russell 2000. It's a volatile index, but it's a whole lot more stable than a stock. This is one of the problems with a stock is you can get these overnight gaps that are 50% or more, and you can really lose a lot of money that way. So I wanted to stick with an index. And then I just started trading these two types of trades on that index. I did two things. I did a simple bullish vertical, and I did multiple variations of butterflies. Now, if we come back down to here, the bullish vertical is something that translated into something that I call the bull. It's extremely simple. The highlights in doing a trade like this is, and I'm just going to show you the guidelines and everything for this, but the highlights are there's no technical analysis. You don't have to spend hours and hours searching for stocks. There's no adjustments. You check it once a day, 2 trades a month. It's good for like an IRA account, and it's got a win rate of 73% for very, very little work. If you look at, this is actually a price matrix in a software that's called OptionView. If you look at this, you essentially sell a put vertical. That's what we call 10 delta, and you buy another one that's 30 points away from it to cover your risk. If you look at an analyzed graph, it looks like this. So essentially, this is a trade that makes money if the market moves up or if the market stays still, and it'll make money if the market comes down a little bit. Now, I want you to pay attention because I'm going to give you the rules for this. It's super simple, and it's really so simple that you're probably not going to believe that it works. And if that's the case, I urge you to just back trade it. It's really, really easy to back trade because there's no subjectivity. There are no adjustments. It's 2 trades a month. It can be traded it can be back tested in a software like OptionView for 10 years in about an hour. And if you don't have OptionView software to back test it, I can give you this guy's name, James Hogan at OptionView.com. If you tell him you're working with me, he'll give you an extended free trial so you can do that. So you really have no excuse. You just come in, take the rules I'm going to give you. You get the free trial of software, and you can just back trade it. There's no excuse for doing that. And so go ahead and do that. Test it, and the results you're going to get from this, you're going to do better than 90% of all the traders out there. It's really fantastic. So here is, let me just show you a document here. If you back traded this since 2002, so that's 14 years of results. The trade had this is what the S&P did over the last 14 years. We lost 23% in 2002. The rest were winning years except for 2008, and the rest, again, were winning years except for 2011, which broke even. You take a system like this, right, which is very, very, very simple, and you just put this trade on every month, and following the guidelines that I give you, which are very simple, it pulls a 23.6% annual return without compounding. Now, you have to keep in mind that most fund managers, most mutual funds, their benchmark is the S&P 500, and very, very few of them actually beat the S&P 500. Yet you can do something as simple as this and actually get this type of results. So, even if you throw in some sort of a slippage number, or in other words, for slippage I mean, maybe you can't get executed at the prices you think you can, even if you account for that, you do that. And again, I'm not selling this. I'm just going to give you for free how to do this. If you don't want to go crazy looking for stocks and you're just kind of looking for a place to put your money that's better than a mutual fund and probably going to make more money than you're trading, then this is something that's fantastic with that. So, and I'm going to tell you something too. I mean, unless you're extremely skilled at trading and you've had years and years of development, you're going to have a really, really, really hard time consistently beating these results on a portfolio level. I mean, you might have a better year with certain strategies if you happen to have a strategy that favors the market, or you might see these guys who say, hey, I got 1,000% return on this trade. But the thing is, those trades that are 1,000% return, I mean, they're really, really high-risk trades, and they're trades you'd be foolish to allocate more than just a 0.5% of your portfolio to, because if you do stuff like that, you're going to blow up, right? So this is very, very effective that anybody can do. So I'll show you the guidelines or rules now, which are extremely simple, and I kind of pretty much told them to you. You go from current slide. It's like, what is this, 6 lines. Basically, you come in 65 days before expiration. You put on this trade where you sell a 30-point wide full put vertical with a short delta at 10. You have a maximum. This trade should give you a $250 credit or thereabouts. If you take that away from the $3,000 of the width of the spread, you have a capital number of $2,750. You don't need extra money for adjustments because there are no adjustments. The trade hits a $250 loss. The trade is removed. It has a maximum gain of $250, but it's usually not going to hit that. But it is going to be removed when the back month or the following month is ready, 65 days to expiration. So what that looks like is you'll put this position on, 65 days to expiration, 10 delta. You'll have your verticals. You'll be in a position that looks like this. As time goes by, this line does rise. The market comes down. Whoops, excuse me. Let me go back. The market comes down to the point where this is lost. In this case here, $2,500 because this is a bigger position. The market loses the amount you could possibly make. Excuse me. You get down to that point, you exit. So if today this went down to 1080, you'd have to get out of the trade. Other than that, as time goes by, this gets further and further back. So essentially, unless you have a really hard down move, then that works. So that's the super simple trade that returns very, very well that I wanted to show you. So when I do this, I'm often asked a few questions, and the first question I'm always asked is that, can you do this on a call side? Because if you can do it on a put side, why can't you do it on a call side? And the general answer is no, you cannot. Because unless you're timing the market, the call side usually loses, and there's 2 reasons for this. First is the markets in general, they spend more time rising than they do falling. And second is that you get paid more to put on a put vertical spread because people are afraid of the downside. People are less afraid of the upside, so you don't get a whole lot of credit for this upper side. And therefore, this, unless you're doing some sort of market timing technique, in most markets, this is actually more of a break-even type of a trade. Certainly in an uptrending market, this is going to tend to lose. So because of that, this is not viable as a strategy. So the second question I always get is, why don't I make this into a condor? Well, my first statement is, well, because the call side usually loses, in which case you're always making up for your losses with your put side. And oftentimes when this put side loses on a both vertical spread, it's going to lose anyway because the call side usually doesn't have enough power to offset a whole lot more than what the other trade was. Now, that doesn't mean that you can't make money with this strategy. There are adjustment strategies on condors where you can move stuff around, but really, unless you're extremely skilled at that or you're timing the market, generally, most people are just going to make money in a straight bullish vertical. So I don't usually do that. And the third question always is, what if the price comes down, or what do you do when the trade goes against you? And the answer to that's simple. I mean, for 90% of the traders who only have a basic skill of complex options position management skills, what you want to do is you just wait until you get your stop out point, you exit, and then you wait till your next cycle and you try again. In case you're wondering, if you're one of those traders who should be just kind of waiting and trying again, if you have to ask what to do when the market comes down against a vertical spread, then you're one of those traders who should just exit the trade at that point and just move forward, wait for the next thing. Because here's the challenge, right? Most traders can't accept losses. They say, the trade's going against me, I have to do something, I can't lose the trade. And unfortunately, this is the exact same reason that most traders, when they're at a certain level, they fail to make money in the markets, because they're always looking for this foolproof way, or a way they can't lose the trade. And ultimately, that leads to their failure, unless they're at a certain skill level. And it's a skill level that somebody can't put in your head, and it's not a skill level that you can get from certain fixed situations, right? The reality is that, unless you really know what you're doing with position management, when you fix it, you're probably going to make it worse. So the way most people are taught to fix, for example, a condor, most people are taught to fix a condor. If the market comes down into this level, they're taught to roll this side back and then double size it, because they're trying to get the credit back. Because by the time that happens, the trade's down so much money that if you just rolled the position back by itself, you wouldn't have enough credit to continue on. So they roll it back and they double it. That is just taking on excessive risk to the downside. You're doubling your margin in the trade. So you have to keep excessive money aside for the trade. And plus, it's kind of a blown-out account, waiting to happen. So you don't want to do that. And the other thing they do is they take this side and they bring it down. And most of the time when the market comes down, it's like a spring. It blasts off the other way. And when they do that, they're creating excessive upside risk. So, adjusting spreads in that way isn't terribly useful. So what we want to go for is, so you can do a simple vertical strategy like that, or we can do something else. We can do, if you're going to start trying to defend options positions, one of the things you want to do is you really want to understand how to trade. You want to understand how these options positions react, and ways to defend the positions in a way that doesn't take on increased risk when the position goes against you, yet when the position reverses, it still is in good shape. So I have a program called the M3 program, and that's what the program's all about. I'm going to kind of go through an example with you. So the trade's called an M3. I'm going to go through an example that's May 2014 expiration. And this is a time that's actually very, very choppy in the Russell. These candles are they're actually huge. And for most income traders, this would be kind of an income trader's nightmare. It's even tough on directional traders, because if you catch the wrong direction, it's really hard. So the M3 position, if we look at a matrix, looks something like this. It's essentially a butterfly, or this is just our entry position, is essentially a butterfly with a deep in the money call on it. The options here, or this call, is placed specifically in a certain location so that it makes a delta correction, but it doesn't negatively affect the theta, and or it doesn't significantly negatively affect the theta and the volatility levels of the trade, so that the butterfly portion of the trade can actually operate properly. So this trade here is entered something like this. We have our butterfly, we have a deep in the money call for our delta correction, and we create a very, very flat T+0 line. Now, the purpose of this trade, right, we have all different kinds of trades and complex options trades that we deal with, mostly dealing with vertical spreads and butterflies. But the purpose of this trade is to help you be in the market, learning how to trade, while you're in a safe position from price movement. So you can see how flat the T+0 line is. And not only is the T+0 line flat, it's also stable. Depending on how you position your options, this can be a real problem out here because we have what some people call a sea of death, where if the market moves forward and drops and comes into here, because they don't know how to hold a stable T+0 line out here, the position drops out. If you're doing the M3 properly, that won't happen. So also, all your risk in this position, in a position like this, is actually on the downside. So I'm just going to jump out here into option view and show you a position like this. Just scoot this over here. And hold on, I'm sorry, that's the wrong one. Get this up. And this here is, let me go back trader. Go to 321. Sorry, I thought I had this set up. So this here is essentially an M3 entry. Again, very, very butterfly, very flat T+0 line. This is the exact same one we showed. And I'm just going to kind of quickly go through this. How much time we have left, Reed?
We have 15 minutes right now.
Okay, great. All right, that's fine. All right, so this here is the entry position. I'm just going to scoot this forward to 326.14. Come on. And show you that the market is at 11.95 now. We have a significant drop in the market down to 11.66. And if we take a look at this, the market's come back into the butterfly, which is kind of what we want, kind of not. Because as we come back into the butterfly, we start to take on all the risk in this position is to the downside. So we want to make a correction to this essentially when the market starts to pull back under this position here. So that being the case, I'm just going to take this butterfly here at 1170, and we're going to roll this back. And by rolling this back, you'll see that we don't affect the T+0 line. We're essentially restarting the trade the way that it was, only now, in this particular case, we've gained a little bit of profit. So from here, I'm just going to pop to 4.2. And I think what we had is basically a market reversal. So from here, if we look at our position, we were way back here in the butterfly. Now we're way up here. So if we look at the price charts, we entered up in this range. We had a significant drop, and now we're reversing. So we get outside the tent. Now the good part about this is the way we're handling the options and the way we're placing them is we're keeping the T+0 line nice and stable. One of the things that tells you your T+0 line out there isn't stable is positive vega, which is the position is where it sits as positive vega. That basically tells you that your T+0 line value is being held up by this long option, and when the time value comes out of that long option, it's going to come down. So what we're going to do is there's several adjustments we can make. One of the things with the M3 is it's a unlike that little bullish vertical thing we did, the M3 has a lot of different types of adjustments you can make. So it's really a process, and within the program we show you all that. But here, so we'd want to make something, so we would just kind of roll this forward. And so let's kind of pop this up to half an hour. So we're just going to take this, and we're going to roll it forward, but we're only going to roll it forward enough to be in a position like this, so that we still have a lot of downside room, where our T+0 line is still relatively flat, and we have our Vega situation's been corrected, right? So this is where we would roll this to. Now, if we go forward to the 10th, Let me just quickly shoot up there. And we have a situation where the market came down hugely, right? We're down all the way down to 1128. If we look at our position now, we're all the way back here. Right, again, we're just checking this once a day. The markets, like I said, came from up here all the way here. Obviously, we need to make a downside adjustment, so we essentially do the same thing. We move forward, and we put our position back into this level. Now, when we put our position back this time, though, one of the things that happened is because we're closer to expiration, we start taking on what we call too much delta, too much price movement risk. So we come in here and we actually do 5, 1100, 1110 verticals and flatten the T+0 line out. So now, even after this large move, we've come here, we've backed off to this point here, and now we've adjusted the downside, but we don't have any risk to the upside. So coming from there, we just go a couple more days. Let's see the 22nd. And this has a profit target, by the way, of just $5,000. So if we come to the 22nd, I don't know what that brings us. And then, okay, yeah, so now the market's back up again. Now we have a position out here. We have a positive Vega situation, which is telling me essentially that this line is no longer stable. So I can do a correction with that by simply coming in here, and let me go to the right month, coming in here and doing something like this, right, which is going to correct our delta. It's going to bring our Vega negative, and it's going to give us a position that looks like this. It looks like this here. So this position is real nice. Again, still really resilient to the downside. And then if we shoot up to, let's see, the 5th, the market just comes back, and this particular trade makes out okay. All right, so this is where we probably exit the trade because now we're up over our profit target, and you'd be into something like this. Now, the point of this exercise isn't necessarily to make a ton of money here. The point of this exercise, or the point of the program, is to learn how to control your T+0 line. Ultimately, we show you these positions where in like butterflies and condor structures, but the reality is once you get skilled at this, you're going to have options all over the place. So if you take a look at a more current position that we have going on, it looks something like this. You can see there's options everywhere, right? And we have our call option. But the thing is, by trading the M3 system, what we're trying to teach you to do is we're trying to teach you to be able to go into a position that's like this and be completely comfortable with what it is, what it's going to do, and how it's going to be managed. And that's the point of that. So this is what the position looks like on the analyzed graph. You'll notice it looks very similar to the position we had before. This is a current thing we have going on, and this is different prices, though, just so that it's not live, because we can't do that with the company I'm with. But this is the position we're in, and it's very, very safe for the market reversal because the market's been down a lot. Now, should the market really take off to the upside, I'm not risking this huge loss to the upside, right? And again, we still have plenty of downside room. If we should take another 15, 20-point hit in tomorrow, we can adjust this and just kind of follow the market down. So that's the type of trading that we're trying to do with the M3 strategy. So this is a trade that it doesn't have hard guidelines. It's a process. It's a process that's thoroughly explained within the M3 course. The general parameters within the trade are here, right? We have a maximum delta of plus 50. We have a maximum minus delta of minus 50 to minus 100, depending on the location. And we have if you have a $50,000 trade, you'd have a $5,000 profit target, $5,000 max loss. So that's essentially what that is. Now, I think I'm getting out of time, and I'd like to take questions if we can, but that's about how things work. Now, if you want to be a better trader, make more money, let me show you how to get to my website here. I give away a lot of free stuff. If you want to join our mailing list, which we just send you our stuff, you get a free report, 7 Secrets to Becoming a Successful Trader. I also do this options webinar every Monday morning. I have actually four trading systems that I have out, and we cover the trades within the systems every single week. So we've been doing this for, I don't know, I think I've had this going on since about 2010, where every week I come in and update the trades in real time, and you can, we do this webinar, and you can follow me with the trade. I answer your questions. There's virtually no sales in the webinars whatsoever. It's just it's for your information only. Really, you'll get more information in just one of the free webinars than you're going to get in most paid classes. And like I said, the best part is I've done these for years, and you can access the previous webinars are on my blog at lockeinyoursuccess.com. Just go to the blog, and you can see years worth of webinars and trade updates there. You can see how the trades have performed. You can see that we've been doing it for years, and like I said, we do them real time. So, and I'm often asking, why do I offer that for free? And it's because the reason is I love helping people. I mean, if you can come in and make trading work for you with the information I provide that's free, I think that's great. I mean, it'd be great if you sent me a note or something just telling me you've been successful, because I love that, and how it's improved your trading. But, if you need more help in that, then we have programs and systems if you want to really skyrocket your success there. And I'd love to do that as well. So do we have any time for any questions? Let's see. How do I even do this? I guess we don't. Okay. Do we have any questions? Okay. So let me see if I can open this up. Let's see here. I don't think that's for me. That's not for me. This is, does anybody have, let's see, okay, this is not for me. All right, so if you're new to trading, where would you suggest I start? I think I did get that with the other webinar.
It looks like if you want to scroll all the way down.
Well, I trade on a professional auction. Yep. I scroll all the way down. Okay. All right. So, okay, nice comment here. Thanks, Sven. I appreciate that. You can read that comment. And all right, someone with a lot of options trading experience, how long does it take to learn the M3? If you have a lot of options trading experience, you'll pick it up really quickly. If you've been having challenges with options, controlling your T+0 line, the M3 will really, really advance you in that. And I developed the system, and I learn from it every day. So, so you can do that. Can you correct virtually any trade? You'd be amazed at what you can do. I mean, obviously, you can't correct everything. There are times when you're going to take losses. That's why we have a maximum loss limit on all our trades. In order to lose a maximum loss on an M3, or what we would call a maximum acceptable loss, you'd have to have something really, you're either not doing it properly, or you have something really weird happening in the market. Like you entered the position and you got a 40, like a three standard deviation down move in the market the next day, and volatility just took it out of you, something like that. So that's the type of thing that may put you down in the trade, or there may be a huge gap if you hold it close to expiration. But other than that, it does very, very well. And basically the system is designed to keep you in the market without drawing down a whole lot, so that you can learn how to manage the position. Once you learn how to manage the position, you can go ahead and you can deal with that. So very, very nice. Why would I want to risk? Okay, so this is a bullish vertical spread. Why would I want to 3,000 to make 250? It's not a smart thing to do. Well, first of all, we're index. And if you look at history of how far an index drops in a day, and you model the T plus 0 line, and you're even somewhat responsible, and you get out when it's down $2, then you're not really risking $3,000. Realistically, this system has been traded through the worst financial crisis we've ever seen. It's been traded, it's crashed, it's been through 2011. There's not been a time when it's taking significantly more than the max loss number. Sometimes, if you had a $250 max loss, you might be $300. If you get maybe $350, if you get to something like a flash crash, I mean, that takes $500, right? But 3,000 is not really a realistic loss if you're managing the trade properly. Now, if you do this on a stock, that's a different story, because the stock can go down to zero. But you're looking at an index like the Russell 2000, the biggest down move in history, and that's 64 points. If you project that out and you keep the trade away from expiration, that's the other key, keeping the trade. If you take the trade into expiration, which you're not supposed to do, you're supposed to roll it over when the following month is 65 days to expiration, which is going to leave you approximately 30 to expiration. If you do that, then this T plus 0 line, if we take a look at this here, this, even with you'll not see that number for quite some time to decide. So if you're even somewhat responsible, that $3,000 loss really isn't a realistic number. So that's what I have to say with that. And the reality is, like I said, a lot of doing things a lot more risky than this, doing directional stocks and day trading, oversized. So that's what I have to say there. So I guess if there are no other questions, thank you everybody for your comments.